So market cycles. There's a great book by a guy named Howard Marks. Howard Marks is the CEO and founder of a company called Oaktree, which manages about $120 billion, mainly private and high-yield debt primarily in the US. And he wrote this book on market cycles. And he's a great investor. He's not a market timer, though. So his theory is the economy generally will grow over any long-term cycle, and markets will rise and fall. They'll be more expensive at certain periods of time, maybe today. So there's a lower probability for decent returns from this point. And then, of course, they will get less expensive when there are going to be greater probabilities of returns. So let's relate this. First off, should you try and time this? Short answer is no. Should you stick to your tactics? Yes. Such as asset allocation, rebalancing, and defensive cash flow assets, which we'd like to now get into. So there's a newsletter, we've written this newsletter 2 or 3 times called Cash Flow is King, and there's a quote here by Oscar Wilde. A cynic is a man who knows the price of everything and the value of nothing. And one of the things that you might not know is that when we look at the cash flow of an asset, so from your perspective, it's the rent on a building, it's the dividend on a stock, or the cash flow being generated by a private company. That cash flow is 3 to 4 times, the price is 3 to 4 times of that asset more volatile than the cash flow. So while I can't predict the price, I probably can reasonably predict the cash flow. And that's the focus. I want to buy assets that generate cash flow. And then I want to use the cash flow to acquire more assets that generate cash flow.